Brad Williams, Frugal Finance. In this video, we're going to talk just briefly about trade executions. This information is from the SEC. What is a trade execution? What investors should know. When you place an order to buy or sell stock, you might not think about whether or how your broker will execute the trade, but where and how your order is executed can impact the overall cost of the transaction, including the price you pay for the stock. Here's what you should know about trade executions. Trade execution isn't instantaneous. Many investors who trade through online brokerage accounts assume that they have direct connection to the securities market, but they don't. When you push that enter key, your order is sent over the internet to your broker, who in turn decides which market to send it to for execution. A similar process occurs when you call your broker to place a trade. While trade execution is usually seamless and quick, it does take time, and prices can change quickly, especially in the fast-moving markets. Because price quotes are only for a specific number of shares, investors may not always receive the price they saw on the screen or the price their broker quoted over the phone. By the time your order reaches the market, the price of the stock could be slightly or very different. No SEC regulations required to be executed within a set period of time. But if firms advertise their speed of execution, they must not exaggerate or fail to tell investors about the possibility of significant delays. Your broker has options for executing your trade. Just as you have a choice of brokers, your broker generally has a series of markets to execute your trade. For stock that is listed on an exchange, such as the New York Stock Exchange, your broker may direct the order to that exchange, to another exchange such as regional exchange, or to a firm called a third market maker. A third market maker is a firm that stands ready to buy or sell stock listed on an exchange at publicly quoted prices. As a way to attract orders from brokers, some regional exchanges or third market makers will pay your broker for routing your order to that exchange or market maker, perhaps a penny or more per share for that order. This is called payment for order flow. For a stock that trades in an over-the-counter market such as NASDAQ, your broker may send the order to a NASDAQ market maker in the stock. Many NASDAQ market makers also pay brokers for order flow. Your broker may route your order, especially a limited order, to an electronic communication network that automatically matches buy and sell orders at a specific price. A limit order is an order to buy or sell a stock at a specific price. Your broker may decide to send your order to another division of your brokerage firm to be filled out of the firm's own inventory. This is called internalization. In this way, your brokerage firm may make money on the spread, which is the difference between the purchase price and the sale price. The graphic below shows your broker's options for executing your trade. You call in via your computer, your brokerage order form, and they have a bunch of different options. And this is growing more and more each day. Seemingly, there's a new avenue in order to execute trades. Your broker has a duty of best execution. Many firms use automated returns to handle the order they receive from their customers. In deciding how to execute orders, your broker has a duty to seek the best execution that is reasonably available for its customer orders. That means your broker must evaluate the orders it receives from all customers in the aggregate and periodically assess which competing markets, market makers, or ECNs offer the most favorable terms of execution. The opportunity for price improvement, which is the opportunity but not the guarantee for an order to be executed at a better price than what is currently quoted publicly, is an important factor that a broker should consider in executing its customers' orders. Other factors include the speed and the likelihood of execution. Here's an example of how price improvements can work. Let's say you enter a market order to sell 500 shares of stock. The current quote is $20. Your broker may be able to send your order to a market or a market maker where your order would have the possibility of getting a better price than $20. If the order is executed at $20.05, you receive $10,025 for the sale of your stock, $25 more than if your broker had been able to get the current quote for you. Of course, the additional time it takes some markets to execute orders may result in you getting a worse price than the current quote, especially in a fast-moving market. So your broker is required to consider whether there's a trade-off between providing its customer orders with the possibility but not the guarantee of better prices and the extra time it may take to do so. My suggestion when it comes to executing trades, put limit orders in. That way you don't have to worry about this stuff here. If you do a market order, you're subject to the spot price, the current price, and it fluctuates. And especially in a fast-moving market, let's just use this example. The current quote is $20 in a fast-moving market. On the downside, when you hit that go button, this 20 could be 1975. That's how fast markets can move. You have options for directing trades. If for any reason you want to direct your trade to a particular exchange, market maker, or ECN, you may be able to call your broker and ask him or her to do this. But some brokers may charge for that service. Some brokers offer active traders the ability to direct orders in NASDAQ stocks to the market maker or ECN of their choice. SEC rules aimed at improving public disclosures of order executions and routing practices require all market centers that trade national market system securities to make monthly electronic disclosures of basic information concerning their quality of execution on a stock-by-stock basis, including how market orders of various sizes are executed relative to the public quotes. These reports must also disclose information about effective spreads, the spreads actually paid by investors whose orders are routed to a particular market center. In addition, market centers must disclose the extent to which they provide executions at best prices than the public quotes to investors using limited orders. These rules also require brokers that route orders on behalf of customers to disclose on a quarterly basis the identity of the market center to which they route a significant percentage of their orders. In addition, brokers must respond to the request of customers interested in learning where their individual orders were routed for execution during the previous 6 months. With this information readily available, you can learn where and how your firm executes its customer orders and what steps it takes to assure best execution. Ask your broker about the firm's policy on payment for order flow, internalization, or other routing practices, or look for that information in your new account agreements. You can also write to your broker to find out the nature and source of any payment for order flow it may have received for a particular order. If you're comparing firms, ask each how often it gets price improvements on customer orders, and then consider the information deciding with which firm you will do business. Now, this is a dated information back in 2013. Clearly, over a 12-year period, there's a lot of changes. So let me know what you think about this payment for order flow. Is it fair? The Citadels. You look at that guy who runs Citadel and he's making a couple $1 billion a year. Is that fair? Comment. Let me know. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.